Hey there, it's Mike Wise, CMG Home Loans, and your weekly mortgage update. Some interesting trends this week and in the broader economy as a whole in the market here. So let's get to some of the details here. So, couple of things. One, home buyers have more options right now. That means that the inventory is up. From 5 years ago, it's been the highest that we've seen as far as the inventory is concerned. I'll show you that in a little bit. BLS jobs report last Friday showed up 177,000 jobs, 4.2% unemployment rate. That was showing a very, very strong economy. But when you look underneath the hood, maybe not quite so much, but in any event, that showed on Friday very strong figure. Likely that it's going to be revised down over the next 2 months. So this is the job gains here. It's kind of showing it going across the road there. So let's see here. Housing inventory up big. This is basically rose 7.5%. This is over the whole country here. So just keep that in mind. There's states, the state-by-state analysis, but you can see the homeowners, they have more choices now today than they did 5 years ago. And so that's a very, showing the inventory is going up. The Fed, this week, they put a pause on the Fed funds rate. We knew that was going to happen. There was a highly likely that they were going to have a pause there. They have another meeting in June and July. The anticipation here is that, or expectation is that there's a chance that they lower them in June, but really everybody's looking towards July. I think they're behind the 8 ball on that, and I do think that they should be lowering, like the rest of the world right now, lowering the Fed funds rate just slightly, a bit at a time here before there is some type of big number that comes out that basically shows we're in a recession. So if I were the Fed, and again, they're way smarter than I am, but I would start to lower in slower increments here over time here, showing that they are working with us to make sure that the economy stays on track and stays strong. So one thing that I wanted to show you, this is the bill that was introduced in 2023. This is for the exclusion of the capital gains tax on principal residence and raising it to $500 for single and $1 million for married. That's double what it is right now. This was kind of introduced to kind of spur home sales so that people would pay less capital gains taxes on their properties, so it gets more properties on the market. So that's good. So all right, here's the jobs data. This is what we're looking at here. So I'm going to go through this a little bit, but basically the interest rates, the bond market really reacts to data that comes out on that day. Rarely do they react to revisions in the data later on. And so the jobs numbers over the last couple of years, they come out very strong, and then they're reduced, and then they're reduced, and they're reduced again. And so let me just show you that, because the bond market really kind of shoves those off to the side when they do have those revisions. So this is January of 2025. The first reading was 143,000 jobs. The second reading, which was revised down to 125,000 jobs. The third reading was reduced down to 111,000 jobs. So when you take a look at it, it's down 32,000 jobs, or 22% from the initial reading at 143,000 jobs. Now, that is happening every single month, right? And so it's down 22%, down 32%, down 19% so far on March of 25 data. So what I'm trying to tell you here is the numbers that the bond market likes to trade on, the economists look at, is how strong the economy is doing and how strong the job market is doing. And the reality is of it, it comes out very strong, and then they do the revisions. And so what would happen if they came out with the third readings first, and how would the bond market react to all of those revisions there? So a lot of things in the jobs market, a lot of different things that I'm not going to go into, but this is definitely something that is of concern. So This is inventory. We talked about the inventory. So this is kind of 2017, 18, 19, 20. And so you can see the inventory going down there, right? Well, now we're starting to go back up here, but let's take a look at, this is kind of 2020 right here. So we were at, this is the pandemic. So we're getting up to the pre-pandemic inventory levels right now with houses, right? So that's making it a buyer's market a little bit. So they're being a little bit more picky with their data here. So it is, the inventory, it is going up, but it is very different from state to state here. And so let's take a look at that, concentrated in a few state inventory issues. Florida, Texas alone, 32% of the total active inventory in the country, right? And both states are about 25% above the April 2019 limits or levels. So those are the pre-pandemic levels. Now, we're just looking in California here. So let's look at California. Basically, number of listings is up 6.8% as of April of 2025. New listings up 8.1%. But if you look at April of 2025 versus April of 2019, they're down 11.7% in California. So California market, it is not as, not like the rest of the country right now. And the inventory, it is, while it is picking up, it's still well below the pre-pandemic levels there. So here we go. This is 9 states with inventories levels above the pre-pandemic. So Texas, Colorado, Florida, Tennessee, Arizona, Utah, Washington. I was talking to a loan officer in Tennessee this week, and they were saying it was becoming more of a seller's market there. I'm sorry, more of a buyer's market because there was a lot of inventory out there. So a lot of kind of adjustments here at this point in time. So let's see here. Mortgage market, we're talking about the Fed kept the rates down a quarter. Probability of 66% in June for the Fed to lower the Fed funds rate. I think they should do it, but we'll see what happens here. We'll see what this probability goes up over time. And mortgage rates, 6.88%. They're trending a little bit higher right now, so let's take a look at that and just see where we are on the market. So this is the prices on the bonds here, and let's see here. So in fact, I'm really messing this up here. So let's go to the 10-year yield, and we're going to go 3 months. So on this here, the yield, it's jumped back up here. It's hitting a resistance level here. We're up to 440, 435 right now. So if we do hit that 440 level, we're hoping that it bounces down here, because you can see that's where it hit last time, is this level, the 440. So if we bounce off of that, we may see a bounce down here, but what we don't want to see is for it to go through here and up to the 460 level. So we're thinking that it's going to bounce off of there, but we'll see with this trade deal with China over the weekend and how that goes. There's a chance that if something very, very strong comes out of that, people are going to go to the stock market, put their money in the stocks, and the stock market is going to rally, and the bonds will suffer, and the yields will go up. So we'll see what happens here. But a lot of stuff going on in the mortgage market, and hopefully that was a great update for you. If you have any questions whatsoever, please let me know. I will be available this weekend. Give me a call with any questions. Text me, call me, whatever you need to do. Hope you have a great weekend, and we'll see you next week.